So, welcome everybody. Thanks for having us. We are here having the fireside chat with Jeff, Lynn, and me, Christin, Friedrich, about the European crowdfunding market and the lessons learned from the first $1 billion, or actually pounds, raised. And we're excited about this opportunity to share with you some insights from our market experience from the last decade. We went a far way, and especially great to have Jeff here with me, who is a veteran of the industry. And we have really to be grateful in Europe to have been able to create so much more awareness and clarity about what crowdfunding actually can do, because we all started with the goal to give more access to finance to companies, and also to have an easy access and a cost-efficient way to invest into great deals for investors. My name is Christin Friedrich. I'm CEO and co-founder of Innovestment. We are a lending-based, originally equity-based crowdfunding platform in Germany, based in Berlin, with the edge between entrepreneurship, sustainability, and innovation. And I'm also chair of the non-executive board of the European Crowdfunding Network, in which we are, as platform providers, come together to make the big impact crowdfunding can have in Europe visible to European institutions and the society as a whole. And also Jeff is involved there, and Jeff is also not only co-founder and chairman of Seedrs, I would say even maybe the biggest platform in Europe, as far as I can see, but also very active in the coalition of digital economy and in different organizations. And as a lawyer, he was massively involved in the come about of the ECSP, the European Harmonization, which we will also talk about today. And so we will jump straight in. We will cover a lot of different topics. That's why I fireside chat. It's an opportunity to cover as many themes as possible, so you get a good insight of what's going on. And maybe, Jeff, let us just start. And I wonder, maybe you could share with us how you and Carlos came about to fund Seedrs 10 years ago.
Absolutely. Great to be here. Thanks, Kristen. I will say at the outset, I was having to look through some old documents earlier today, and I came across a version of our business plan that had a team page with pictures of Carlos and me from about 10 years ago. And you used the word veteran to describe. I think that's right. The time, you know, the ravages of time and trying to build out this industry. We look very different today from what we did then. But we started out really just with a very, I think, simple view, which was that it would be great to be able to use technology, use the internet to create a market in equity capital for growing businesses. You know, this is a little section of the capital markets that's traditionally been denominated by a limited number of sort of institutions. And that has meant that both from an entrepreneur side and an investor side, it's been very limited. Entrepreneurs have had limited sources of capital to whom they could turn to grow. Investors have largely not had the opportunity to invest in these businesses. And we said, you know, what if you take all these wonderful things the internet does, bring businesses looking for capital together with investors who want to allocate it together, and create a market that way. And not, you know, even the term crowdfunding has taken on a kind of life of its own in the decade or so since we started out. But our passion has never really changed, which is, you know, making an efficient, effective market for all types of businesses, all types of investors to interact.
So this is maybe good to mention that we're here focusing today on our chat to equity crowdfunding for startups, because that's what you mainly do. And this is also what is good to concentrate on something, because crowdfunding is so diverse and broad, and we have, like, it's a big family from reward, donation, equity lending, and all kinds of forms and shapes. And it's also very beautiful to see how different markets and different platforms are operating. Could you maybe see, Jeff, share some of your data with us, just so we get a little bit of a glimpse of what kind of investment amounts, investor size, and so on you have?
Absolutely. So, we started working on the business in 2009. We had a long regulatory process, so we launched in 2012. So we've been going for about 9 years. In that time, we've seen about 1.1 billion pounds invested through the platform across about 1,350 deals, with a pretty significant growth rate, you know, particularly over the last few years. So last year, I think we did just shy of 300 deals, and a few hundred million. pounds invested. And you know, that comes from a very wide range of different types of investors. Our minimum investment is £10. We see lots of 10, 50, £100 investors coming in, either because, you know, they're small investors who want to build a portfolio sensibly, or because they are just there to back a particular business. And then we see, you know, really angel and institutional size investments at the other end, and really everything in between. The deals we do are also the full range. I mean, we like to say we're sector agnostic. You know, a lot of what we do is tech or tech related, but I suppose every business has tech today. I mean, it doesn't mean what it did, you know, at one point. You know, but we're also within that doing food and beverage and consumer products, automotive businesses, and you name it. And so companies come to us to raise anything from, you know, £100,000 or so for kind of a pre-seed, you know, or you know, concept stage round, all the way up to £5 or £6 million. Here in the UK and Europe, we operate under a prospectus limit of €8 million maximum, about £7 million. And so we really try to do that full range.
Do we have multiple companies who are raising multiple times actually, or? We
do. So of those 1,350 deals, that represents maybe about 700 separate companies. So what we have a lot of is companies that come back, do multiple rounds with us. And often their first round will be a smallish round that they'll do wholly on the platform. And then later on, they'll go combine the money they raise from Seedrs with money raised elsewhere. So they'll do a bigger round that'll be partly venture capital, partly external investors, and then partly through us. And we like that. And so we see businesses, we've had businesses raise 10, 12 rounds with us, or at least have a portion of, you know, 10 or 12 rounds come through us, and we love that. Other times people raise once through us and then move on their journey, and that's great too.
So what would you say, what are the main advantages of crowdfunding for this kind of businesses, that they also are recurring customers?
Well, I think there are a few. I mean, I think fundamentally we've always viewed, and you know, as you said, crowdfunding broad term, and I think that the advantages are different for different types. But within the equity crowdfunding space, at least, I think, you know, the core advantage is it's access to a very deep capital pool, being able to tap into the capital of both our sort of large base of retail and institutional investors who use the platform, alongside, you know, the company's own base of customers, friends, supporters, etc., all through a fairly simple online process, is really, you know, creates a great benefit for businesses. It is a straightforward way to access capital that doesn't require, you know, going around the houses to every VC and some of the traditional ways of doing it. But then it does go beyond, I think, just the capital. And I think one of the things that many of our businesses value is the forms of support they're able to get from the investors that invest in them. And we often think about sort of value add investors as being sort of big old gray haired VCs who sit on boards and tell you how to run your business. And there is value to that. Our investors, I think, provide a different type of value. You know, when you've got 1,000, 2,000, 5,000 people, all of whom are invested in the success of your business, a lot of good things can come from that. You need introductions, you need support, you need even some, you know, people to, you know, test your product out. You can draw on that installed investor base. And so I think what a lot of companies, even those who, you know, are raising money from multiple sources, what they really value with us is, you know, is capital, but capital that comes with a large base of supportive investors.
So you could say that investors have a kind of skin in the game, so they also become ambassadors of the company, consumers, partners, and the other way around. What we could see in the last years that more and more already is more established companies are using their existing customer base to buy into them, right? Like some banks did, Monzo, but also Tomorrow Bank in Germany, which raised 3 million. So these are actually best practices where new technology companies are brave enough to do the step and to leverage in a way the potential.
Exactly. I mean, there's no stickier customer. There's no better brand advocate than somebody who actually has a financial interest in your success. And so that's why we're seeing, you know, huge numbers of companies that really, you know, that do need the capital, but would have a lot of choices for where they get the capital, choosing to come to us because you get this sort of synergistic and symbiotic relationship that you might not get through other channels.
So you don't see any challenges with other financing forms to combine it, like it's the old myth, which was in the first years of crowdfunding doesn't work with venture capital and stuff. It's actually bullshit, because the crowd is also in a way a filter, right? I mean, just to add what I always see the crowdfunding industry in a way is that already you have the filter as a platform, then you have the filter as a crowd, and it's such a great proof of market to actually de-risk investments also for other capital stakeholders in a way.
It's interesting. The dynamic between, us and crowdfunding generally, I think, and some of the established providers, it is a complex one, and it doesn't always follow a sort of straight path. I think there's this concept of co-opetition where you're competing one day and cooperating the next, and I think we face a lot of that. But by and large, the way I see it, particularly when you think about our role versus venture capital firms, is that it very much parallels what you see in the public market between fund managers and self-directed investing, both of whom can sit alongside each other perfectly well. There's an important role for fund managers who charge management fees, but hopefully can pick outperformers to go into the fund. And there's an important role for people who just want to invest, and build up their own portfolios. We obviously provide that. We work together with many of the VCs. And I think what we've tended to find through the years is that the better the VC, the happier they are with us. The third tier and fourth tier VCs, I think, are very concerned about the competitive threat that we pose. The top tier VCs tend to see us as exactly what you say, as a filter, as an opportunity to create a bigger base of early stage businesses from which to choose from, and often a co-investor.
Could you bring a bit of transparency into the user experience from the project and investor side? I mean, how do you, because crowdfunding also has the opportunity, and when you did 1,350 deals, you have to be quite efficient, you have to be quite automated, you have to have a high customer satisfaction rate in order to get new good deals in. How do you manage your onboarding and due diligence process?
Well, I mean, that's really it, that gets to the core of the business and the core of the challenges we have. And there isn't one simple answer, but I think that, trying to get the right balance between, at one level, automating processes, but also having enough sort of hand-holding, enough sort of manual intervention, at each stage is one of the, it's really one of the hardest things here. I often talk about kind of our tech as not just the pure tech. It's not just the ones and zeros that go into the code base. That's very important, but it's also almost the process engineering and the systems, the systems development that's required to do this all well. But broadly speaking, we try to put as much onto the platform as possible, have as little kind of bespoke human interaction as possible. There are certain stages, particularly around closing, closing a deal when we're co-investing with others, that does require us to do a certain level of manual intervention. But we feel that the more we can make the experience, again, similar to the public markets, and some important differences from the public markets, obviously, and private companies are a very different asset class, but in terms of the experience and in terms of the execution, the more we can allow investors to get on, raise, allocate capital businesses they want to, execute all through a fully online process. And the more we can allow businesses to raise capital through at least as online of a process as possible, that allows us to do more deals. It allows us to keep costs down, and it allows both investors and entrepreneurs to do what they want to do as efficiently as possible.
So could you, from the 1,350 deals, filter out a certain metrics to easily find out which companies are worth to present to your customers? Because there was this early belief of marketplaces. Okay, we maybe keep the filters not too high in a way, but let the crowd decide. But as many of us practitioners learned over the years, in the end, if a deal fails, it's always also coming back to the platform in a way, right? And of course, and this is something so important I want to stress here, because we have always this regulation stuff, which we come also to in a second, where you feel like, okay, investor protection is so important. That's why they try to regulate the platform so hard. Even I would say, as a platform, this is the biggest goal of us, to keep our investors safe, protected, and present them good deals. So how do you manage this to bring enough good deals through the door?
Yeah, no, look, it's a fantastic set of questions, and I think, I think first what I'd say is, we distinguish very much between, deals, what deals do investors want to back, and making sure that the platform has deals that are popular and can get funded, and then there's the question of which ones go on to succeed, and we have a different sort of approach, a different thought process for both. When we started out, our idea was we would put up as much as we could and let investors decide what they wanted to invest in. And I don't know, maybe 20% of our deals actually funded and the other 80% didn't. And my theory at the time was that's fine, right? Like, that's the wisdom of the crowds exercising its judgment. But as time went by, what we started to find was we could look at deals and know pretty quickly whether they were likely to fund or not. And it wasn't a really good use of anybody's time, our time or the company's time, to be putting a bunch of deals onto the platform that we basically knew weren't gonna be able to fund. And so, we've gotten to a point now where we actually curate quite heavily. We only take about 3 or 4% of the deals that we see, and in turn, something like 90%, 95% of the deals that go onto the platform wind up hitting their target. And that isn't us trying to exercise our own business judgment, but it is us saying we know what the market is likely to want, and so we're going to try to put out deals that investors want to back. But then you've got the second issue of, okay, what's our goal here? Are we trying to give investors deals that they find interesting to invest in, or are we trying to ensure that deals that these companies don't fail? And in our view, it's very much the former. One of the things about early stage investing is it's high risk. It is inherently an asset class where you will have a number of failures, and actually where you make your money is from a limited number of very big successes. And so we want to facilitate that. We're not trying to protect against the downside. We're trying to enhance the upside. And our view is that the more deals we can put out there, the more opportunities we give investors to find that 10x, 20x, 50x return, that's going to wind up being best for investors. And you're right, that doesn't always jive with what some people's concept of what's right for investors might be. I mean, our view is that investor protection is critical, but that comes from disclosure, that comes from screening, that comes from making sure that you understand the risks of what you're doing. If we were in the business of just trying to pick winners, that would kind of make us a venture capital firm, and that's a very different model. And it has its place, as I say, but it's not what we're trying to do. We're trying to create a market.
Could you explain a bit more about your model, maybe about what kind of instrument, how does it work? Also, maybe some specialties like the secondary market, and also recently you were also placing a fund, an external fund to raise for your platform.
Yeah.
And this kind of specialties you have developed over the years.
Yeah, absolutely. So, the core model, what you think of as what one probably thinks of as primary crowdfunding, is simply business comes on, seeks a certain amount of money, a particular valuation, investors come and invest in it. In our particular case, the way we structure these deals is that, the company is issuing shares. It's straight, ordinary, common stock, but we hold those shares as nominee for most of the investors. Some larger investors, if they want to hold their shares directly, can do so, but we act as nominee for most of them. And the nominee concept isn't a particularly well-known one outside of a few common law jurisdictions, but it is a very useful structure, which looks like a trust arrangement or a custody arrangement where we're holding the shares on behalf of the underlying investors. One of the advantages of that model is that it then makes it very easy for us structurally to facilitate a secondary market. And in 2017, we launched our own secondary market, really just to see how it would go. We didn't have a huge amount of a view in terms of what the demand would be, but we saw that people were interested in it, and we thought we'd give it a try. And it's been a huge success. We see loads and loads of activity going through it every month, and a lot of that is driven by the fact that what happens is everyone's trading up beneath the nominee. So we act as legal shareholder, and it's nominee trading for, trading under the nominee, beneficial owners trading with beneficial owners. That has worked very well. That's gotten around some of the legal complexities when you're talking about transfer of shares, private ownership. And so it's been a very, very effective structure for us, and it's been growing significantly. And recently we've started to add on things like secondary campaigns. So now, even if you haven't raised on a primary basis with us, you can raise secondary capital through us in a variety of ways. And then, as you say, we also, we don't just do straight companies, we do funds as well. And we actually have done fund campaigns for a long time where you have the opportunity to invest in a venture capital managed fund through us in a smaller ticket that you might be able to do offline. But we recently did one for Passion Capital, which is a very prominent VC over here in the UK, and really an outstanding investor who's backed some of the great British tech businesses of the last few years. And that really got attention. We've done a bunch before, but none of them were quite as high profile, or we weren't able to publicize them as much. But the Passion deal, I think, has really opened people's eyes to the prospect of using crowdfunding, not just for straight companies, but actually for fund investments as well.
I love this. I also see this in Germany or in Europe generally, that more and more other capital stakeholders are realizing the potential to leverage their own capital. Why not diving into the huge amount of private capital which is lying around on debit accounts, like in Germany alone, with over 2 trillion euros just lying around and are not used in the ecosystem. And it's really, and this is also what I hope for regulators to understand, that this is something we have to access together to actually have some money to create these huge innovations which we need now in the time we're living. And so I really appreciate it that platforms like you were able to create such a visibility and let's say not only best practice, but also proof of the potential of crowdfunding. And if you see, like generally, maybe just for the audience, they are the lending-based scene, for example, they obviously do plain loans, but it's also all the variety of different instruments which are used, and we're still all in a way testing out what is best, the best use for the investors and the companies. Because what you were just mentioned, and this would be also my next question regarding how to balance out user experience, usability, and regulatory requirements. We are in a very highly regulated market, and it's quite a pain sometimes as a platform provider to have all these warnings and feel like instead of marketing for it, you try to push them out.
Yeah.
And it's like all this crazy stuff which you have to navigate. How do you manage this? How did you find a balance here?
Well, I think the honest answer is that a large part of it for us, and a large part of why we've managed to deliver what we have so far, has been, that here in the UK, we've had a very effective regulatory regime that has struck the balance between investor protection and commercial viability pretty well. And it is strikable. It's not that any of this has to be. It's not that creating a good user experience and a regulatory regime that protects investors have to be at odds with each other. I mean, you can do sensible, right things, put investors through a process that ensures they understand the risks, make sure that you're doing the things that ensure that people aren't losing money they can't afford to lose, or don't get into something they know they don't know where they don't know what they're doing. You can do that with a limited amount of disruption to the user experience, if the regulator and the regulatory regime is flexible enough to allow you to. And I think one of the things that we've been benefited from really here has been, an evolving regime that, with a supportive regulator that has allowed us to build out a model that I think, from a user experience perspective, might be a little clunkier than Amazon. This is still regulated financial services. It's, you can't just go on and do one click and it's done. But still, it tends to be a fairly smooth and efficient process. And I think one of the things that, as other countries and groups of countries around the world look at their own regulatory systems, trying to strike that balance is going to be critical. Because if you put in, as you say, if you put in too many sort of barriers to people investing, well, then great, nobody loses their money, but nobody invests either. And so then you don't wind up with particularly successful outcome, either way.
I can just say we already miss the UK and the European Union, because we need you. It's so heavy, it's so crazy how, especially if I see the German regulation. I mean, we're maybe coming now to ECSP as well, which have you massively been involved, and we can be again grateful that you put so much effort in there, Jeff, with a few other stakeholders in the industry. to over years educating the European Commission and other policymakers to understand what crowdfunding actually can do, how it's done, and what in a way it needs in order to use its potential. And we just have now at the moment the situation that it will be implemented in November, but now at the moment it will get introduced in a way in the member states, in the practical arena of the national specialties. And we see that there's quite a regulatory competition coming up because some member states just don't get it. And it's really frustrating to see how do you see maybe the development, the advantages, the opportunities, the chances of the European framework, which so many of us hoped it will be a big breakthrough for the European crowdfunding market. Do you see this will be possible? And yeah, how do you feel about it in general?
Well, I'm excited by and broadly bullish on the ECSP and the European framework. I mean, it was a lot of fun participating in the process as it came together, and it was a really interesting lesson in sort of how these kinds of laws get made. I mean, we had spent years and years, all of us here in the industry had been working for years to try to convince the European Commission to do something about harmonizing crowdfunding regulation, because it's been hugely scattered, hugely fragmented, and in many ways sort of conflicting across Europe all these years. And I had largely given up. I had sort of thought this is going to take 30 years before the Commission does anything. And then out of nowhere in late 2017, we were all called to a meeting in Brussels to say, hey, actually, we're going to propose something. And then, it was a long process, still navigating it through to passage, but it was an exciting one. And I do think, it's very much to the credit of the folks within DG FISMA, the part of the European Commission that was responsible for this, and many of the folks in the European Parliament as well. They worked very hard to get a good solution. And I think what's come out is pretty good. But it's not perfect. You've got 27 member states, each of whom has their own views on these kinds of things, that vastly different sensitivities around things like investor protection, things like retail investment, and vastly different levels of priority around, funding small businesses. And so, while we're in some ways we're very fortunate, it was a regulation, not a directive. And for those not intimately familiar with the mechanisms of European law, that's an important distinction, because when most laws that come out of Europe are directives, which basically means that each national parliament has to implement it and can implement it in their own sort of way, and there's often a lot of variety. What we got here is a regulation. It's directly applicable, and there are only certain areas where individual member states are going to be able to carve out their own rules. So we're starting from a good base. I do think that you're going to see some countries that really kind of muck it up, but I think you're going to see a lot of other countries that make a success of it. And so I am optimistic. I think there's going to be confusion and a hard slog at times in getting it to work, but I think over the next year or two, the sort of rough edges will get smoothed out, and we'll have a pretty good system in place.
Yeah, that's the thing. It's not about that it's perfect. It's the beginning. It's about the next step, and us all learning in the process how to also educate and help the regulator, who is very open actually, or the policymakers, to make it work if they really understand. But it's a lot of effort on everybody's part. That's why it's so great that people like you took the time, because we usually as entrepreneurs don't have the time, right, to put so much effort in. It's so important. We can just say in general for everybody who's listening, it's so important to be active and to try to put the point across what can actually be done, because the process can make it happen if you are active in a way. Jeff, we are already running out of time. We have just 2 minutes left. It's so exciting, and we for sure have to do this again with more time and speak about some things we maybe didn't touch today. But what is your, maybe it's a final statement or final thoughts about where the crowdfunding industry is going? What are your goals with Seedrs? And are there any maybe also learnings, lesson learned in the last decade you would like to share with the audience?
There's a lot for 2 minutes.
Yes, it's true. I just noticed. Oh my God, and it's just 1 minute now. So.
Well, look, I think the short answer is that I think we're going to continue to see crowdfunding's role in the private company finance ecosystem, grow and grow. I think we're in a one-way track here. At times it has gone more slowly than we would have liked in the past, but I think a lot of things have come together, new regulatory regimes, both in the EU and an updated one in the US. I think the traction, the proof points as platforms like Seedrs start to see some big exits, which we have had. We had something like 180x exit, very small investment, but sort of mind-boggling returns this quarter. We're beginning to give the kind of proof points for the model. So I think you're going to continue to see it grow and grow, and I think that the opportunity for platforms like Seedrs is to continue to be a significant part of the ecosystem. I mean, we have a vision here at Seedrs of a day when every growth company has Seedrs somewhere on its cap table, and every growth investor has a Seedrs investment in their portfolio. And I think that's something that we can hopefully deliver. We continue to work hard to make it happen, but alongside the many other great platforms out there, I think we're continuing to build an industry. By no means an overnight success, but it is a success story, and one that's got a long way still to go.
Wow, perfect use of the 1 minute time, Jeff. Thank you so much for being here with us, and thanks for Craig Asano for inviting us from NCFA. And great event, the FFCON. It's great to come together to share experiences and to create, in a way, the future of finance with a new mindset, a new narrative, and actually, just also more fun to say. Like this, So, Jeff, see you soon, and I wish you a wonderful day, and all the best for the next years to come.
Likewise, Christin. Thanks so much.
Thank you. Bye.
Bye.